Hey everyone, it's Jay Soloff from Investors Alley, and this is our options trade of the week. So I'm here at marketchameleon.com, and I'm looking at GDX, so the VanEck Vectors Gold Miner ETF. Saw that there was quite a bit of option volume today, and I wanted to take a look. So, of course, GDX is a highly, it's a very popular ETF. Trades gold miners, so oftentimes used in lieu of pure gold exposure in a portfolio. It's got a market cap of 16 billion, so you know it's heavily traded, and over 343,000 options trading today. So that's why I took a look, wanted to see what is interesting that might be going on. Stock was up about 3.5% today. So if you look down and just sorted by quantity here, you have a lot of longer term, interesting to see a lot of Jan 2022 trades, put trades, maybe some put selling to juice the yield, maybe a little bit of put buying, like married puts, perhaps buying the stock and buying the put. So interesting, a lot of interesting longer term stuff. But what really caught my eye was this Jan 2023. And the reason that I find that interesting is that with exchange traded funds, you can go with exchange traded options, generally speaking, like you don't see a whole lot of action once you get to about 2 years out, not even 1 year out, except for some of the bigger indexes and stuff. But even 2 years out is pretty rare. You can see that this strike only has 31 contracts of open interest. So 1,000 lot, a couple years out is pretty unusual. Usually catches my eye when something like that happens. So this one looks to be a put sale at the 25 strike with the stock about 37. So my guess is that this is a way to juice the yield. Either someone's already holding GDX or they're doing this in lieu of holding GDX. And you know what this does, it's about an 8% yield over a couple years, so about 4% a year. But if you look at, the stock does not pay much of a dividend at all. So you're holding GDX, you're getting that exposure to gold, but at the same time you're adding some decent percentage, then around 4% for a year to have this. And it's not a whole ton of risk, because if you look at GDX, it hasn't been below, outside of the brief period during the crash, where after that in March where it quickly recovered, hasn't been below 25 since mid 2019. Probably not going to see gold and thus gold miners collapse, for the foreseeable future. So for the next couple of years, it seems reasonable that 25 won't be breached, or if you take into account the premium, 23 before this trade would actually lose money. So probably a reasonably safe way to add some yield to a trade. And here, so we're looking at the graph, and you can see, outside of this period here, which was pretty brief, where it dropped below 25, hasn't really been. You can see here it was in the 20s for a while, and this was when gold was a lot cheaper, and rates were a little bit higher. But rates have gone down and gold has gone up, and outside again of this period, we're quite a bit higher. And essentially, there's not a whole lot of belief. Rates should remain relatively low for probably the next couple of years. They may start to rise a little bit, but enough to get gold back down to where miners are in this 20 range. Probably not. And even so, you're not talking about a huge risk. Even if it goes all the way back down there and the put's sold at 20, there's not a whole lot of risk of losing a lot of money, because that, over time decay will take away that premium. So I think this is a relatively safe trade to be made, likely in terms of additional yield. So if we look, it's all the way out 764 days. So it's a long time, obviously. There was some open interest at higher strikes. But here's that trade. Only one other contract traded besides that 1,000. So not a lot of action down here. But again, probably not a whole lot of risk to have this one on, and just an interesting way to generate yield. So you could do this as a cash secured trade. If you have enough cash in your account, you can sell the put and just you cover basically that $25 from 0 to 25. You'd have to be able to cover that amount, minus whatever you're getting in premium. So you could easily do this trade as a cash secured put as well. So if you're interested in cash secured puts, or they're very close cousin covered calls. So cash secured puts, covered calls are extremely similar. They essentially the same payout structure. So if you're interested in that sort of thing, there's a report on covered calls here just below this video, and it's completely free. So if you're interested in getting started with covered calls and potentially cash secured puts, check it out.